ECB's new device fails to affect as Italy confronts political paralysis. Amsterdam, London. A new European Central Bank tool to defend indebted states from soaring borrowing charges failed to impress investors on Thursday, with many worried approximately a lack of element and conditions that could make it tough for the likes of Italy to use. Unveiled alongside its first hobby charge hike in 11 years, below the Transmission Protection Instrument (TPI), the ECB will buy bonds from countries whose borrowing charges relative to Germany it sees as soaring via no fault in their own. For markets, the maximum pressing want for the TPI is Italy, which this week noticed the crumble of its authorities after Prime Minister Mario Draghi resigned, placing the second most indebted Euro sector member on course for early elections. Italian markets signaled unease, with bond yields rising and the intently watched hole between Italian and German borrowing fees growing towards degrees that during June prompted the ECB to begin work on an anti-fragmentation tool. Danske Bank leader analyst Pete Christiansen stated the device regarded cumbersome and no longer as clean to spark off as markets had probably hoped for. That is why markets are punishing Italian bonds as they're right now, actually because it's now not clean whilst and the way the ECB will interfere, he delivered. To be eligible, a country must comply with the European Union's currently suspended financial guidelines, no longer face severe macroeconomic imbalances, its finances need to be considered sustainable, and it ought to have sound and sustainable macroeconomic guidelines compliant with plans submitted to the EU for its COVID-19 Restoration Fund. Sources advised after the ECB's declaration that all Eurozone countries were eligible based at the situations. But Christiansen referred to that won't be the case within the destiny, depending on what a brand new Italian authorities looks like. In 2018, a conflict among a brand new populist government in Italy and the EU sparked a massive sell-off in Italian bonds. The ECB wants to prevent borrowing fees in weaker states inclusive of Italy from rising too sharply so it can raise fees to tame inflation without annoying approximately fragmentation risks. Deployment of the device became at its discretion, Lagarde stated, and the ECB can regulate the criteria. Lack of details. The ECB mentioned TPI would be activated to counter unwarranted, disorderly market dynamics that pose an extreme chance to the transmission of financial coverage across the euro region, although those parameters have been left undefined. Market observers stated they were worried about a lack of detail around how and whilst the device would be deployed, and the ECB's willingness to use it. What the markets don't like is that Lagarde said numerous instances she hopes it is no longer activated. The fact that she confused that and harassed the ECB's pandemic bond buy reinvestments places it lower at the list for dealing with anti-fragmentation chance, mentioned Marcel Alexandrovich, European economist at Saltmarsh Economics, relating to ECB President Christine Lagarde. Sources also advised that policymakers did no longer discuss on Thursday Italy's bond marketplace turmoil and do no longer count on to apply the tool imminently as situations do no longer warrant it. Analysts welcomed the ECB's declaration that purchases below TPI could be unrestricted, which means the program is doubtlessly unlimited in size. But they mentioned that it did now not specify how its capital key precept of purchasing bonds in relation to the size of economies might observe to the program. Neither did the ECB specify the time horizon over which purchases could take location. The TPI is strong in idea, however could be susceptible in implementation given the vague specification of its operational parameters, said Andreas Jobst, head of macroeconomics and capital markets studies at Allianz ETR, ALVG. This makes it very hard to assess whether it is able to be sufficiently powerful.